how much of this crazy volatility, I know your rates, not equities, but how much of the whole thing do you attribute to the Fed? Are they behind the curve?
I attribute a lot of that to the Fed and the Fed pivot. There's been this, just over the last few weeks, the markets, the Fed has essentially told us that they could go sooner, they could go faster. And what I'll be watching for is, is that their base case? Because as of the December dot plot, the Fed was only talking about 3 hikes. The market's pricing in 4 hikes this year. Are they going every meeting? That's 7 hikes this year. So I think the Fed has injected volatility in the market. Now there is economic volatility, but I think what the Fed's suggesting, if they are behind the curve, how much more are they going to go? They're also talking about the balance sheet. And I think the Fed may view the balance sheet and rate hikes as sort of equivalent tools. The market really cares a lot about that balance sheet.
Yeah, and I'll stick with you before I go to Mark. Priya, follow up on that, because we had a chart, I think it was last week, and I don't know if we still have it. Maybe we'll show it tomorrow. And it showed effectively the stock market in the U.S. and the Fed balance sheet over the last, I think it was 5 or 10 years. And they were spot on. They were so correlated that it was almost impossible to tell them apart. In other words, as the balance sheet grew, the stock market grew with it. How much of that deleveraging should concern our audience?
So, as on an academic basis, or even from some sort of Fed policy perspective, there's no direct link, because the Fed pumps reserves in the system. The reserves are held by the banks, and the banks don't buy stocks. But there is absolutely a link, and I think the link comes from real rates. So if you look at long end real rates, they've risen significantly. That's why I think we're seeing that deleveraging. I think these real rates have more room to rise. If the Fed wants to slow things down, they want to tighten financial conditions. Remember, every hiking cycle, that's the aim. So it's not an unintended consequence. I think the speed of it, maybe too much. But the real rates, we do expect long end real rates to rise, and that's going to tighten financial conditions. It's the speed that we're all sort of grappling with. So I think there's more volatility in store, because the balance sheet does drive those long end real rates much more than rate hikes.
Mark, your take on the Fed, and also talk to us about rate hikes and markets in general, because I know we've kind of been conditioned to think that, rate hikes bad, rate cuts good. Stock markets have gone up in history when Feds have been raising rates aggressively. 1994, 1995, one of the best years for the Dow in 95, came off a 2.5% move higher by the Fed funds rate. What's your correlation?
I think we tend to think about it the same way, to the extent that, of course, we're going to see a bit of market volatility just as the Fed is going to turn the other direction relative to this kind of very easy monetary policy we've seen for long. But I think the main reason is that equity markets are typically doing well, is that the Fed is only really hiking when we have a relatively strong economy, and that's what we're looking at. So we're looking at a U.S. economy that's likely to grow close to 4% this year. Financial conditions are very easy. Corporate earnings are still growing at a solid pace. So it's still a good environment to be an investor. But of course, it's creating a bit of volatility just as the Fed is starting to move a bit in the other direction.
Your clients are going to want to own stocks. They may change the kind and style of stocks they own, Mark, but they're going to want to own stocks, and we're down. Let's keep it at like 10%. Let's keep that in mind. We are still well up year over year. What are you advising your clients to do right now?
So we're certainly advising our clients to hold significant portions of their portfolios in equities. We have a sector view that favors energy first and foremost, but also financials. So we have been kind of forecasting for yields to move higher. We also have short duration in our fixed income positions. And these are essentially parts of the market that have been doing well. We have not been tilting over to some of the more overvalued tech. And I think, per your comments before, Brian, I think the relative valuation of tech has certainly gone up as, say, the quantitative easing pushed down yields, in particular in the long end of the curve. And we're seeing a bit of a reversal of that. But there are significant parts of the market that I would even qualify as being cheap at this point in time, in particular when we look at it relative to where overall yields are. So from an asset allocation perspective, we're still happy to own equities, but we tend to favor, as mentioned, energy, financials, Eurozone over, say, more the expensive and the US market.